Bismillahir Rahmanir Rahim. So, we are going to continue our analysis of the oral double auction. So let me summarize the discussion that we have had in the last lectures. So basically, the experimental evidence shows that in oral double auction, there is convergence to equilibrium, especially over a repeated sequence of games. The reason why is not known at this time, and many people have said that this is a mystery. There is a supply and demand model which predicts convergence, but it predicts convergence in a certain way. It says that there will be excess demand. If there is excess demand, then the demanders will bid the price up. Or if there is excess supply, then the suppliers will reduce their prices. But in the oral double auction, we never find out about excess demand or supply. So so obviously the mechanism which is said to work does not work. The mechanism would work if we did what is the Walrasian auctioneer mechanism with recontracting. So the auctioneer announces the price. People who want it, they raise their hands. People who want to supply, they raise their hands, and he sees that there is a mismatch and he changes the price. If this was the mechanism, then we would understand why convergence happens. But this mechanism is not there, and nothing similar to this is there. So the question is, how does this convergence happen? Now the Gode-Sunder paper makes this mystery even more deep, because what they show is that the convergence happens even though the human beings need not learn anything. He puts in a computer simulation with agents who have zero intelligence and no learning, and the only thing that they need to do is to avoid making a loss. So the seller must sell at a price which is above cost, and the buyer must buy at a value that is below value, and convergence occurs. So something very strange is going on, which they don't understand and they don't explain. Then there is a paper which misunderstands the reason of convergence, and this paper, Cliff Bruton, this paper says that the Gode-Sunder result is not right. It occurs because of the symmetry in the supply and demand. So that analysis is wrong. It is not the symmetry in the supply and demand which leads to convergence. The correct answer as to why Gode and Sunder have convergence is given in the Plot et al. Paper. Actually, it's not Plot, it's 4 authors, but I remember Plot is one of the authors. So what they show is that the convergence occurs because in that structure, and in many other structures that you could think of, the buyer with the highest value has an advantage and the seller with the lowest cost has an advantage. And if it happens that these two will trade first, then they will get out of the market, and then at the next point the demand curve will shrink. The highest point of the demand curve will go down, the lowest point on the supply curve will go up. So now the next time the trading is carried out, it will be the gap between the highest cost and the lowest the gap between the highest value and the lowest cost will be smaller. And so this will keep happening This is what they call the Marshallian path. If trades happen in exactly this sequence, then convergence will occur without any learning and without any particular without experience. So basically, if Marshallian path is followed, where the highest value bidder trades with the lowest cost, then you will get convergence. And this doesn't have to necessarily involve anything else. So the mechanism is not that there is excess supply and the suppliers bid the price up, or there is excess demand and the demanders bid the price up. The mechanism is that if the highest value buyer trades with the lowest cost and the trades occur in this particular sequence, then automatically convergence will occur. So they find designs in which the Marshallian sequence or the Marshallian path does not exist. And then they show that the zero intelligence traders do not converge. So, but even in those cases where there is no Marshallian path, human traders do converge. So the mystery remains that how do humans converge to equilibrium when they are not following the Marshallian path? So the question, so obviously, the convergence also does not occur immediately in one game. It occurs across a sequence of games. And again, this is an issue on which there is a big controversy and debate. Is it valid to think about a sequence of experiments? Do we, in the real world? So this is the question to answer which we cannot look at the model itself. We have to answer, is this a good model? We have to look at what real world situation are we trying to model. So that's something that we need to think about, and we will later on. For example, we can construct a model of the market for tomatoes. We can say that, okay, people plant tomatoes and every day there are a certain amount of ripe tomatoes and they bring them in. So these supplies fluctuate randomly. So now demands could also fluctuate. And so we can create an agent-based model and we can ask, will there be any convergence? Apparently, because the supply randomly fluctuates daily and the demand also fluctuates, so we need not get any convergence to any type of equilibrium. So these are then we would have to say, okay, let's look at this model and let's look at what happens. And those are the type of models that agent-based modeling can handle and standard economic theory cannot handle. So what is so the question that we want to ask is, how do humans behave in the real world? Now, one very important thing to understand is that this is not the question that economists ask, because economists already know how humans behave. Humans that in economics model, they have full information and they maximize. So, and this is by assumption, and in fact they enforce this assumption. That is, they say that if a model doesn't have maximization, then it's not economics. So economists are prevented from learning about reality, and that's why these very, very simple baby questions are still open questions, because economists don't explore these questions. That's why the experimental economics and the behavioral economics and the psychologists have been discovering for a long time that human behavior is different from what economists believe, and they have been communicating these results to economists, but economists have not been persuaded. Still, the standard model that you see in your economic theory textbook is that humans know everything and then they maximize, and this is not true. I mean, if we run one experiment, we will find out that this is not true. So that is the question that as experimental economists we like to ask. How do humans behave? What is the knowledge that they have, which is not full? And how do they act upon this knowledge? And what are the features of this knowledge and what are the features of this learning mechanism that lead to convergence? This is an open question. So there are three cases that we want to look at. First I want to do an experiment. So plot, and they created an experiment in which there was no Marshallian path, but that experiment of theirs is a difficult one. I mean, we could do that experiment and see how convergence occurs in that, because there is no Marshallian path. So the zero intelligence agent will not converge. So now then, what kind of intelligence, how much intelligence is needed to create convergence? This is something we could study in experiments, but their experiment is a difficult one, because what they do is they continuously replenish demand and supply. So as soon as a sale is made, you give that person who has sold. Actually, they don't give the person who has sold. They give that would create certain biases. They give the same unit of the same value to some seller chosen at random, and they add 1 unit of demand to one of the buyers chosen at random, so that the demand and supply curve, instead of shrinking like it does in the Marshallian path, it remains the same. So now in this plot experiment, the zero intelligence constrained agents of Gode-Sunder, they do not converge, but human beings still converge. So now the question is, why? So now that one experiment is difficult to do, but there is a very simple, much easier experiment we can do, and that is the one that I did in class last time, which is that if all of the sellers have the same cost and all of the buyers have the same value, then there is no Marshallian path. So even if people drop out, the supply and demand remains the same. And so now the experiment is exactly parallel to the original supply and demand model, because what we do is we say that, okay, everybody has the same value and everybody has the same cost, but there are more sellers than buyers, or vice versa. So now exactly like is supposed to happen in the traditional analysis of supply demand, there should be excess demand. The people who are frustrated sellers, they are unable to sell, they will say, oh, we did a loss. So what they will do is they will reduce their prices, and the buyers, if they are failed to buy, they will increase their bids. So one should have convergence. But actually, so there are three cases. If the buyers are greater than sellers, you have excess demand, price should converge to buyer value, seller gets all the surplus. If the supply equals demand, then we don't know what will happen, because the price could be anywhere between the high value and the low cost, and there is no reason for any convergence to anything. So technically it should be somewhere in the middle, but actually it will depend on the negotiating power of the different parties as to how much of the surplus they can extract. If all parties are symmetric, then we would expect that the price will end up somewhere in the middle, but it could fluctuate randomly because nobody knows. I mean, the information is not there. How much surplus do the buyers have? I mean, if the cost structure was revealed to all the information, if this was common information like is assumed in the supply and demand model, if everybody has full information, then we could be pretty sure that the trading would occur at the midpoint. And you can run this experiment, and actually it would be worthwhile that you reveal the information. Now, when you reveal the information to everybody, if the seller's cost is 50 and the buyer's value is 150, they will trade in the middle at 100, because people have this sense of fairness. If the buyer at 150 says that I won't sell it to you, technically he can, and he suppose that there are 5 pairs and you just have one buyer which you can negotiate with. Buyer says that, sorry, I'm just going to sell at 120. So technically the seller should say, okay, if I don't agree, then I will get 0. If I agree, I will the buyer will sell at the seller says that I will sell at 120. So the buyer will say, I will get surplus of 30 if I buy, and if I don't buy, I get 0. So I should buy. That is the advantageous move. But as we have seen from the ultimatum game, human behavior is not like that. Human behaviors will say that, no, you are trying to take advantage of me. I would rather let 30 points go rather than be exploited like this. So human behavior is not maximizing behavior, and so taking that into account, if the information is revealed, then the justice outcome will prevail. Very likely, we could try this and see that if this is our conjecture about how humans behave, and it's clear that this is not a maximization conjecture, so we can see how it would work in reality if, if we put people in sort of ultimatum game. We say that you have no choice because, see, if they are evenly matched, then it is not true. You see, what the economic theory says is that if somebody is selling at a lower price, the buyer will go to him. But actually, if we pair up the people, everybody will make their sale. So there is no extra unit available except for the one that you have. So this is one thing that is important, that the microstructure matters. How you structure the negotiations. Do you allow everybody to go to everyone and so on? These things make a difference. So the equal case we don't know about, and we put that out of the picture. That's that's not that's not important. So we consider the two cases where either you have surplus buyers or you have surplus sellers. What happens now? The methodological and then technically, according to the S&D theory, gives us a prediction that if you have excess suppliers, then the price will converge to 50. If you have excess buyers, the price will converge to 150. In the game that we played, this did not happen because of microstructure issues. But we can redesign the game so that it does happen, and we would like to do that to see. We would like to have control over the microstructure such that if we change the information and the structure, it convergence to one price happens. If we do the other thing, convergence to the other price happens. But the question is, when we are running these experiments, what are we trying to do? This is very important because the typical economists cannot learn anything from experiments because their methodology says that every human being is optimizing. So automatically they are blind to the reality. They cannot see. And even when you do experiments, like we discussed this book, okay, we do the experiment, we find out outcomes. Now what their job, what they think of as the job of the economist is to create a model in which everybody is optimizing, which matches the results that you observe. Now this is a ridiculous methodology because what they're not trying to find out what really happened. They're trying to create a model in which you have optimization and equilibrium and which produces results which match. This totally ridiculous methodology is the result of commitment to a certain way of certain methodology which is called logical positivism, and they say that only the observables matter. The internal processes of decision making, you see, basically it's like revealed preference. What people actually did, we observed that. What the decision-making process were, how they thought, we didn't observe that. So about that, they can make any assumption that they like, and so they do. They say that everybody must be maximizing. This is known a priori axiomatically without any possibility of questioning. So the economists can't learn anything from the experiments. Now the experimentalists are better off. They do look at behavior, but they are also influenced by this mindset. So they look more closely at the behavior and they look more closely at the experiment, but the end result is the same, that they want to look at the observable behavior and match a theory to that. So this whole book, it said, okay, we have this observation, now we construct a game theoretic model for this, and there are so many articles like this, and in which and we create a model, and then everyone must maximize, and then we calculate the equilibrium, and then we try to see that the equilibrium of our game matches what we observe, and if we do, then we have succeeded in explanation. So this is the meaning of the word explanation, that we construct a model in which there is optimization and equilibrium, and this model gives results which match what we see in the experiment. So this is very different from what we are trying to do here. So I've illustrated this, the Abdul Karim Sadri book on the alternating is just creating a model in which you can apply game theory. And he knows that he makes assumptions like complete information. He says this is not true, but in order to calculate my maximizing strategy, I need to assume this. So let's assume this, and then on the basis of this assumption, then he calculates the equilibrium. Similarly, there are people find this very awkward, that why should we assume full information? So then they go to this other methodology which is called the Bayesian Nash Equilibrium, in which what happens is that you assume that you don't know what other people are doing, and then what you do is you have a prior distribution over this unknown. Now the thing is that in order to get this started, you have to make some common knowledge assumption that everybody has the same amount of information. Otherwise, if I don't know anything about what you know, then I cannot even start to assume, to even calculate the Bayesian Nash equilibrium. So every single maximization equilibrium model makes assumptions about reality which are not true. All of them. Because maximization cannot be done without information. Suppose I don't know anything about how you will behave, then, and your behavior matters in determining the outcome, then there is no way to maximize. So all of these models are wrong. So basically the problem is that the economist methodology assumes information which is not valid. It makes wrong assumptions about human behavior. It makes the assumption that there is no disequilibrium. Convergence to equilibrium occurs immediately and automatically. So then this analysis is completely unhooked from reality. So I was just, there is a paper, Price Formation in Double Auctions. I was looking through the literature to see if I could find something that would be useful, and I found one paper which was useful, but 10 papers which were useless. Like there is this one paper by Gode-Sunder, looks very interesting. So this is exactly the question that I am trying to answer. How does the price converge to equilibrium in the double auction? So this is the abstract. We develop a model of information processing and strategy choice. Sellers form beliefs that offers will be accepted. Buyers form beliefs that bids will be accepted. Then traders choose an action that maximizes their accepted surplus. So now he's trying to get closer to the reality. Instead of assuming that everybody knows everything, they have beliefs about what is the chance that a particular bid will be accepted. And then now with this minimal information, much less than what is assumed by other models. See, other models assume that I know everything about everybody else. So that's clearly wrong. But I can have some idea about, if I put a bid out there, what is the chance it will be accepted. And this probability can be calculated on the basis of past observations of how the game has been played. So they can make some plausible assumptions about this. And then they say, okay, now that I have this, now I can maximize, and then I can calculate equilibrium. But the thing is that this is still very far from reality, because people don't behave in this way. I mean, when you were playing this game, did you actually calculate the chances, and then that for each bid you have a possibility of 5 or 6 different bids, let's say. For each bid you calculate what is the probability that this will be accepted, then you do maximization. This is not how people behave. But this is how economists theorize. So this kind of blindness to reality is there even in the experimentalists' vision. So even if this Gode-Sunder model actually produces a match, the model is still wrong, because this is not how human beings behave. But the economist methodology doesn't say that. As long as the model produces a match to the observations, then they say the model is good. So this prevents them from learning about reality. So the basic flawed methodology of economists is that you observe the outcome, then you make any kind of model you like, you can assume anything you like, and then if the results of the model match the observations, then your model is good. So that's basically a fundamentally bad result. And furthermore, okay, this might even work if they had reasonable models, but the models that they use don't have reasonable assumptions. They say that the agents must be hyper-rational. They must have the ability to calculate everything. They have infinite computational capabilities and they are infinitely selfish. They only worry about their own payoff. They don't worry about other payoffs. And they have infinite willpower. So basically the Herbert Simon approach said that people have bounded rationality, they have bounded computational capability, and they have bounded selfishness. So these are the results. So infinite willpower means that once you decide that this is the right strategy, you follow it. You don't have a moment of weakness. You don't have emotional response that, look, even though this strategy I will lose me 30 points, I will use it to punish that other person because I don't like what he did. No, that's emotional. You should just look at the rational. I'm getting 30 here, I'm getting 0 here, I prefer 30 to 0. So people have this kind of behavior. So as I've said, maximization in equilibrium blinds economists to realities. So the behavioral economics assumes bounded rationality, bounded willpower, bounded selfishness. Now traditional training in economists make these assumptions distasteful. And when the economist tries to create a model, he doesn't like to make these assumptions because they are trained in ways that these are ad hoc assumptions. If you assume bounded rationality, then anything can happen. If you assume people have different types of motivations, then anything can happen. So you're trained to dislike this kind of modeling. That is why economists do not learn how to make good, realistic models of games and human behavior. And that's why we have the opportunity to create good models of very simple situations. So what we need to do is we need to look at real behavior, which will be non-maximizing, and we need to look at disequilibrium, what happens when equilibrium, then how do people behave? And both of these things are outside of the scope of traditional economic methodology. So the right approach is that what we want to do is we want to try to discover hidden reality. We want to discover human motivation. We want to discover how people think. Now this is not observable technically, but actually it's not that far. We can ask people how they think. We can be in the experiment and we can think about our own thought process, and then we can create models. So the models that we want to do is to create how do people actually structure the decision making, what are the things they think about, and then how do they behave, and then how do they learn. So these are the real questions to which no one knows the answers. Even if you look at the literature, they make assumptions about learning which are wrong. Like the Cliff paper, Bruton paper, it says, okay, it's clear that zero intelligence doesn't work. So let us assume the following learning process, which they get from machine learning. So they have this delta and this thing and the other. It's a very complicated learning model which comes from neural networks. So they say, okay, this neural networks, how they learn, this is what we will assume about human beings. Now, if you look at the model, you will find it very difficult to understand. And so to assume that people in human beings use this model to learn is just wrong. That's not how humans learn. So we are trying to make models which are realistic in the sense that they consider the information that people consider, and they make models about learning behavior, which is the process which human beings use to actually learn. And so this can be done by self-observation, how do we behave in these games, and then by observing experiments and running experiments and asking people, well, why did you make this decision? And observing also. So the difference between the East and the West in the methodology is that the West says, okay, any model which matches the observations is correct, but in East we say that a good model matches the unobservables. Now there is a very serious problem with the Eastern methodology, which is why they don't accept it. That if I have a theory about how people think, I can never actually prove this, because it is unobservable, and that is why they abandoned this. They said that we want only certainty. So we always making guesses about how people think, how people learn, and these will never be 100% sure. So we give up certainty and we say, okay, but this is how life is. I mean, in life, in everyday life, I make guesses about what this class is thinking, I mean, how much they are learning, and in your personal relationships, you look at the person smile and you say, oh, he's happy. Although he may be very mad at you, but he may be smiling because of he's just being courteous. So we make guesses and we operate our life on the basis of these guesses. And sometimes these are wrong, sometimes they are right. And there is no way to ever be 100% sure that you know exactly what is in the heart of the other person. But at the same time, to live, we need to know what is in the heart of the person. I mean, we act with the assumption that, okay, he likes me, he doesn't like me, and so on. I mean, so we say that, okay, if I want to get something, I better go to this person, not that one, even though we don't know what is in their hearts. So this is how life operates, and this is how our models are. The Eastern models deal with the hidden reality, and they make assumptions, and we hope that these assumptions are true, but there is never any certainty. And that is why the Western methodology avoids this, because the Western methodology says that we must be 100% sure of whatever we say. So they say that, okay, the unobservables don't matter. Only the 100% certainty can be in terms of matching the observations. There we can be sure, because we see something and we want to make sure that our model produces the exact same thing. So the West tries to match on the observations, and the East tries to match on the hidden reality. So the West can achieve certainty, and that's the goal, that the match on observation is something you can verify. The East cannot achieve certainty because we have models which model the unobservable. So we will never be sure, but we can have a good idea that probably this is correct and probably that's not. So with these general remarks, now the thing that we want to try to understand is this so-called box supply and demand model. In this model, in the first 5 periods, you have excess demand. So this is you have 11 sellers with sale price of $5.70, and you have 16 buyers with the value of $6.80. So the theory says that because you have excess demand, you will have convergence to $6.80. And this is what you observe. In the first period, the excess demand does not get known, and so you have a price trading at roughly the middle, although you do see a little bit of a rise even within the round. Then in the second period, the price keeps rising, and the third period keeps rising. In the fourth period, it's nearly there, and the fifth period, you have convergence to equilibrium. Then suddenly, without informing anybody, they switch the condition, and so now in the 6th to 10th period, you have excess supply, and so now you have 16 players who have supplies at $5.70 and only 11 buyers at $6.80. And you see that even in the 6th period, the price goes down, and it keeps going down until the supply and demand equilibrium. So this experiment shows that in this particular structure, the supply and demand theory gives the right prediction of convergence. Now, There is a question that I am going to put aside, because actually this is a very controversial question. I mean, what the economists are trying to do is to prove that the supply and demand model is right. Now, does this prove that the supply and demand model is right? Well, there is a serious question, because the question is that in this artificial model, yes, it seems that convergence happens, but does this actually represent any real world situation that we know of, where the same setup of supply and demand is repeated across time and people learn from experience? Probably not. If we can find such a market, that would be wonderful. But like in stock markets, the supply and demand continuously keep changing, so it's not clear that this model would be applicable. But anyway, let's put this question to one side and consider this particular question. Still there is a mystery as to why convergence happens to the top and then to the bottom. Why is the supply and demand model showing us the right results? Because in these games it's not clear how the information structure and the microstructure of the game is not corresponding to the Walrasian auction. So there is also no Marshallian path. So obviously learning is happening. So the question that we want to ask is, what are the rules of behavior that human beings follow, and how is it that they learn from experience? It's obvious that learning is taking place, because as time progresses, people are converging. So what is the nature of the learning that takes place? So these are the questions that are important. And as I said, these are not the questions that economists explore usually, because they are tied by their methodology. So my guess is that the key driver for this will be the different behavior between the successful buyer and the frustrated buyer. So the people who are able to sell will behave differently, and the people who are unable to sell, in fact, in the first 5 rounds, what would happen, I would guess, and this is something again that can be verified by experiment, that there will be some buyers who succeeded in selling and some buyers who did not succeed. In fact, there are 16. So 5 buyers failed to sell their goods. So in the next round, they will try to bid higher. And that is what will drive. And the 11 buyers who sold their goods, they will not be so aggressive. So that's something we can verify in experiment by tracking the bids of the successful buyers and the unsuccessful buyers. So this is rather different from the standard model. And so as the successful buyers succeed, then so the unsuccessful buyers should succeed in the second round, because they all will make a higher bid, but there will be a new set of frustrated buyers, and they will see both that the price increase and that they failed to sell, so they will now make an even higher bid. And so this is my guess as to how it might happen. If this is what is happening, then if instead of 11 and 16 we put 11 and 12, the convergence would become substantially slower. So that is something, again, this is a microstructure argument. It is nothing, the supply and demand theorists cannot tell you anything about this, because according to them, convergence to equilibrium will happen in one step. So when we look at the microstructure, then we can see this is a hypothesis. Maybe the learning happens in some other way, in which case, so all of these experiments are things that one can do, and that's why I'm saying that there is a research paper publishable that is available here, because none of this thing is known. So maybe we can, if we run experiments, we can have different numbers of excess buyers, and then we can match the rate of convergence to the number of excess buyers, and if we can find something like that, that would be confirmation of this theory. Maybe it's not. Maybe there's some other mechanism at work. We won't know until we run the experiment. So this is just a hypothesis about how convergence might happen. So after the 5th round, then we start having frustrated sellers, and so they will start bidding down the prices. So this is kind of similar to the original S&D model, that the excess supply causes, but we have a very specific, tightly defined, described mechanism, and in that explains how this convergence would happen. So given that we are doing something which economists don't do, so we are trying to find the unobservable. So how do we find the unobservable? Well, first we run the experiment, then we can ask people how they behaved, and some people are not very clear usually in their approach. They will say, "Oh, I just thought this might be working." So we can do many things. We can articulate. We can say, "Is this what happened?" We can ask about the process. One thing that is useful is to ask them to write instructions on to give. Suppose that we ask them to play the game in a different way, that they should stand, the two people should stand and they should instruct the other person how to behave. So then they will be forced to give them rules of behavior. We can have them stay there and we can say, okay, don't tell the person bid 15. Tell him the rule which he should follow to calculate, and we can ask them to articulate a rule. This forces them to think of a strategy. This is a very useful, that instead of saying bid 15 or bid 12, they have to say, if the leading bid is so much, then you should do so that thing. So when they are forced to write down a strategy, then they will then you will be able to see much better, much more clearly. So again, this is an experiment that can be carried out, and it is better if you allow people to have some experience and then ask them to articulate a strategy, because then they will have a better idea. So these are the things, these are the methodologies that we can follow to discover the so-called unobservable. And what we are trying to do is something which economists don't do, because the economists say human behavior we already know. They have full information, they maximize. So they are not trying to learn about human behavior. So we are trying to learn about human behavior, so we have a different approach. You can ask people about the advice that, okay, you have run an experiment, now the people are going, say, okay, so next batch will be playing this game. Write down the advice that you would give to a player that would help him to maximize his payoff. So that will give you some indication of what they considered as important. Now there is, the economists believe that the money rewards are essential, that if people get money, then they will think clearly. Now there is a lot of evidence which is conflicting about this, that people, any money motivation. So what we could do is, like we played that game, that in every single round, if you make the number of points, we give you cash reward right away, so you understand, and then you pay a lot of attention to how many points you are making. The economist theory is that would motivate you higher, but according to the drive, pink, actually this would have the reverse, the opposite effect. People would get distracted by the money and they would not be able to think more clearly. So it might be better to just give them a reward to make them feel happy that they are here, and then actually if we follow the drive motivation, then what would help is to, like what I did, I said that, look, Asma is playing very well, so that would people vie for standing, social standing. So if somebody gets recognition, then people say, oh, I will try harder. So this is a bigger motivator of people than money. So again, this is another issue that could be explored, but I would not do that in the particular paper that I'm writing. But I'm saying that there's a huge number of experiments which can be done and which would produce information of value which economists don't have, because economists' framework does not allow for this. So what we want to produce is a good learning model that would produce valid predictions about what happens in these games. And in particular, I would like to produce a model of human behavior which predicts that in the ODA with excess demand, the price will converge up, and then if we switch, it will converge down. And I would like to have a model which actually, if we run that game, I should be able to have a good idea of how it will happen. And actually, when I ran the game on you last time, I was trying to replicate this and I failed to do so because I used a microstructure which does not lead to convergence. So the economists believe in the magic of markets. You give the supply and function and demand and magically it will converge to equilibrium. But actually what happens is that the microstructure of how exactly what is the procedure, how much do people know, what are the interactions that they are allowed to enter into, all of this matters. And if the game is structured properly, then maybe there will be convergence. If this game is structured in a different way, there might not be. So the exact details matter. So the Friday game microstructure, let me review this because now we are going to study. So there were actually only 6 players. There were 4 buyers with values of 150 and there were 2 sellers with values of 50. So there was a huge amount of excess demand. And so the price should have converged to 150, but it did not. So why? The way that we did it was that we say, okay, collect all the buyer bids and take the highest bid, and collect all the seller bids and take the lowest ask. And then we match them, and if there is a match, that is the bid is higher than the ask, then we allow them to trade at the midpoint. And if there is no match, then there is no transaction. And the next round happens. So now, immediately, it's clear that the excess demand or excess supply will never get known, will never get revealed. If I was showing all of the bids, okay, here are 2 sellers and there are these 2 bids, and there are 4 buyers and there are these bids, then the excess would get revealed and maybe things would change. I'm not sure. In fact, I will show that information will not change later on. It will not change. So what happened? I thought actually that there would be convergence because it's very similar to the game that I had studied in the literature. And in fact, what they had was that they take the highest value and they take the highest bid and they take the lowest ask. And usually in our structure, the bids are higher and the asks are lower. But usually they are using intersection of supply and demand, so it need not be the case. So they take this and they if the bids are matching, then they allow transaction. If the bids are mismatching, that is the ask is low, the asking price is high and the bid is low, so that transaction cannot take place, then in one of the games they say, okay, you go together and you try to talk to each other and see if you can negotiate a bid. So in those games, convergence was happening, so I thought convergence would happen, but it did not. Actually, the students arrived at the unique Nash equilibrium for the game, as I later calculated, and I will show. So the Nash equilibrium is not the supply and demand equilibrium. Microstructure matters. The supply and demand equilibrium does not emerge by magic. It has to have the information structure and the incentive structure and the learning structure should be correctly matched to allow the supply and demand equilibrium to emerge. Now what we want to do is to show what I expected to see was that the excess demand would manifest itself. The sellers would bid high, the sellers would note that they are able to sell and they would raise their prices. But it did not happen. What happened was that all the bidders started to bid the maximum. We had an upper limit and we will see that makes a difference. So let us assume that the upper limit to the bid is your value. So the maximum bid is 150 and the sellers have their minimum ask, which is 50, which is their cost. So I want to show you that this is the Nash equilibrium. Now, calculating the Nash equilibrium can be quite difficult. Verifying a Nash equilibrium is not difficult. There is a technique that I would like you guys to learn. Finding out what is the Nash equilibrium is a difficult job, but guessing that something is a Nash equilibrium and then proving that it is a Nash equilibrium is easy. There is a standard technique which comes from calculus of variations, which is you say that you put everything at the maximum value and you take one thing and you change it a little bit, and can you improve? So in Nash equilibrium, this is what works. So we say that, okay, there are 4 buyers, they are all bidding 150. There are 2 sellers, they are all bidding 50. Now consider the position from a buyer's point of view and ask, is there any change I can make that will improve my position? So first we calculate what the gain is from the Nash equilibrium strategy. So in Nash equilibrium strategy, there are 4 buyers, 2 of them will be selected at random. So the payoff will be 50% chance of your selection multiplied as the expected value. So if you do succeed, then you will be matched with the 50 player, and so your outcome will be 100 is the price at which the trade will take place. So your payoff will be a surplus is 50. So your expected surplus is 50 times the probability with which you will be chosen, right? Now actually the probability with which you are chosen is not known to you because you don't know how many buyers there are. So but you know that it is positive. This is something that is known to you because it will become known with experience to you actually. So this is something that's a bit tricky. So when you make full information assumptions, you get different results from reality. So in reality, you could calculate this under the assumption of experience. That okay, as you play the game, you have this probability, you guess about this probability. So anyway, the payoff is positive. You assume that you have some chance of being selected. Now suppose I change the bid to 140. What will happen? Well, then the chance of my getting selected is 0 because I know the structure of the game. So I'm calculating Nash equilibrium. In Nash equilibrium, I'm assuming that everybody else bids at their Nash equilibrium, 150, 150. So there are 3 bids of 150 and I am bidding 140. So the actual chance of my getting selected is 0. But actually again, I don't know what is this chance. So I could also have a guess for this. As you will see that there was some fluctuation. So if we make the economist assumption of full information, then this is clearly a Nash equilibrium. If we don't assume full information, then we might expect to see some fluctuations, and we did see actually some fluctuation. It was not an exact perfect 150 across the board. Some people were bidding 140 and some people. So because if people don't know the probability of being selected, then there can be some fluctuation. Similarly for the sellers, the chance of being selected is 1/2. Sorry, it's complete. Oh, I see. No, this is 1/2. So we are. I'm sorry. I'm confusing the games. There is 2 games. Later on, we will consider that all the transactions are made. Here we are only allowing 1 transaction. So the buyer's probability of being selected is only 1/4, and the seller's probability of being selected is 1/2. So now in the game with full information, this is a Nash equilibrium clearly. If you have information about what is happening, then the seller will know that the lowest bid will get selected. So if one of the sellers tries to raise his bid, he will not be selected. So his value from the game is 0. Only if you are selected, then you have some chance of making a surplus, and if you do, then there is a 50 surplus. So actually making the calculations under the assumption of rational expectations, which is not a valid assumption. Rational expectations here means that you know the probability of selection. So for the buyer, the probability of selection is 1/4. The surplus is 1/4 times 50, which is 50 divided by 4, 12.5. For the seller, the probability of selection is 1/2, and the probability of selection is so the surplus, the expected value of the surplus is 25. If you change the bid slightly, your surplus goes to 0. So this is clearly the optimizing strategy. For every player, the optimizing strategy for the seller is to bid the lowest possible, which is his cost, and for every buyer, the optimizing strategy is to bid his highest value, which is his value, which is 150. And so that is the Nash equilibrium for the game. And there is no convergence to equilibrium. In every game you will have 150 is bid by the buyers, 150 is bid by the sellers, and the transaction takes place as 100. And this is what we saw, except that we saw a little bit of fluctuation. Sometimes the sellers would bid 60, sometimes the buyers would bid 140. There is no chance of people learning that there is excess demand. Even if they learn excess demand, it makes no difference. The excess demand cannot express itself in this microstructure. So this is going to be the equilibrium. So I realized that convergence is not going to happen. So I changed the rules. So I'm going to try a different change of rules just to show you, not the one that I actually did in class. So let's see what happens if we don't put the bid limits, because something very interesting happens in this case. And again, this is something that could be explored in experimentation. So suppose that I say, okay, I remove the limits. You can make a bid which is more than your value, and you can make an ask that is lower than cost. So what will happen? So first thing is, how do we calculate what will happen? Well, we have some understanding. We saw the behavior. People are increasing their bid. And basically, we know that people do trial and error learning. And that makes sense in an uncertain environment. When you cannot calculate what is going to happen, then you do trial and error. So people from experience saw that high bids are winning. So they will make, and they also see in the previous experiment that the lowest bid is 50. The cost, they see that the transaction is taking place where the ask is 50 and the bid is 150. So they know that if I bid 160, I'm not going to get a loss. So they will bid 160. So some people will bid 160 and they will win the auction. So other people will follow. And so once the 160 bid is there, then the sellers also can go lower and try to capture the bid. Of course, the sellers don't know that they need to actually know. In this case, with only one transaction, the lower person will capture. So the seller will go to 40. So ultimately, both will keep increasing. It seems clear that this will happen. And so the seller can go only down to 0. So the seller will go to 0. What will happen to the buyer? The buyer can keep increasing until what point? That's the question.
Till the price becomes 0.
No, he's increasing 150, 160, 200. How high can he go? 210. Yes.
200.
At 200, what will happen? At 200, we will have 200 is trading with 0. The price will be 100, and so the buyer surplus will be 50. So what happens when a seller bids 210?
Surplus will go down.
Yes, but that seller with 210 will win the auction, and the trade will take place at 110. He will have surplus 40. So now we have an auction which took place. Everybody bid 200, but one person bid 210. He won the bid, and he had surplus 40. So what will happen in the next game?
250 up to 250.
250. At 250, the trade will take place at 125, and the surplus will be 25. So what happens if one person bids 260? 300, exactly. That is the correct answer. The bid will go up to 300, and because of the at that point surplus will be 0. At 290, you can make a profit. At 300, so actually this is a little bit shady, and experimenters know this. But that's why they pay a price if you complete a transaction. If you win a small bonus for completing a transaction, then 300 and 0 will be an equilibrium. And so everybody bids 300 as the buyer, and everybody bids 0 as the seller, and that leads to a equilibrium which is actually the competitive equilibrium. The price will be 150. But this is purely by chance. It does not really have to do with the competitive equilibrium. So now I want to explain why this is by chance. So this is then there's a new Nash equilibrium. 0, 0 is the ask by the two sellers, and 300 is the bid by all of the buyers. And so this will lead to a Nash equilibrium. One of the buyers will be selected, one of the sellers will be selected. Trade will take place at 150, which is exactly the competitive equilibrium price because of excess demand. But this is a wrong explanation for why this 150 is taking place. The real explanation is different. And so now, to explain why this is the wrong explanation, consider the game in which the askers are allowed to sell at a negative price. They say, I'll give you the good and I'll also give you some money. So this is a very strange game, but let's see what happens. So it is the zero bound on the sellers that leads to equilibrium at equilibrium. So now what is going to happen? So first round, seller bids minus 10 and he wins the auction and the price is 290. So now what will happen on the next round?
Buyer will bid 310.
Maybe, but actually more likely the other seller will bid minus 20, and the sellers have a lot of surplus here they're making. So there will be a competition among the sellers first. So the seller price will go down. Now when the seller price becomes like minus 50, then the buyers will also be encouraged to take a higher risk, right? So they can go to 350 now. If once at minus 10, it is a risk if you bid 310. Maybe the other, this I'm using intuitive ideas about the learning mechanism that these sellers follow. So if the sellers say, okay, I see a bid of 0 and a bid of minus 10, maybe next time again it will be 0, and if I bid 310, I will actually take a loss. And if they don't want to take a loss, they might not. But if they see the sellers keep going down, minus 10, minus 20, minus 30, at about minus 50, they will feel comfortable that, okay, now I can go in with a bid higher than my cost, and since the seller is going to pay me some money, I will not make a loss. So if the sellers have reached minus 50, then they will try to go, they can go up to 350. So the buyers competition will start. So now this game actually has no equilibrium. What will happen, according to my understanding, again this is something which would be a very interesting experience to experiment to run, is that the sellers will keep increasing to plus infinity. The sellers will start going to minus infinity. The buyers will go to plus infinity in small stages, and the price will always stay in the middle of 50 and 150. And now there will be no convergence because things will go to... So the convergence is caused not by excess supply, but by the lower bound on 0. This is a very surprising result. It doesn't have to do with the standard logic of convergence to equilibrium. So this is my conjecture as to what might happen. A real experiment to do this would be really interesting. There's nothing like this that I have seen in the literature. So there's no equilibrium that's possible. The bids will keep going up, the asks will keep going down, but it will go slowly because you can't jump. You are counting on what happened in the last term. So again, this is very strong learning based. If your learning is that you believe that what happened in the last period will happen again, then you will do so. Otherwise, if somebody bids, and possibly it will not, possibly you will flatten out, because at some point things get very risky. Suppose you are bidding 1,000 and your value is only 100, then you are counting on the other guy to bid minus 900, and can you really count on that? So the question is that, but if you see that in the last round 900 was bid, then you will feel fairly confident. So I don't know, as to whether or not prices will converge to plus infinity, minus infinity, or whether people will stop increasing at some point because they feel that it's gotten too risky. So this is something which experiments might reveal if we have smart students. This would only work after students get a lot of experience, then they understand this game, then they will be able to play this sophisticated and advanced strategy. But they will. It's not that this is going to be. And this would occur naturally. We already saw bids going up beyond the cost. I mean, people are complaining that you should not allow them to bid below cost, and you should not allow them to bid above value. So this will happen. People will make bids, and so once they achieve success with this bid, they can go high. So now that's one alternative that leads to one variation. So what I'm trying to emphasize is microstructure. And again, let me explain that microstructure doesn't matter to economists, because they say, okay, I have a theory, and the theory and the equilibrium will take place. But the microstructure is relevant because we are studying disequilibrium, and we are studying how convergence to equilibrium happens, and we see that it makes a big difference, and sometimes it will converge and sometimes it will not, depending on exactly how you structure the game. So now we consider the second alternative, change. So in the first alternative, so removing the ceilings, it leads to, if you bound the sellers at 0, then it leads to convergence. Now actually, you see, I think that another way to show that this is not the demand-supply equilibrium is to say, okay, let's put an excess of suppliers and a small number of buyers. Convergence would occur to exactly the same excess demand equilibrium, even though you have excess supply. So again, this shows that the convergence is accidental. It is not all right. So in the microstructure, we don't get convergence to equilibrium. So we consider the second alternative, which I actually implemented, and I still didn't get convergence, but that was because of failure to learn. Asma really learned the right strategy in the game, but we didn't replay that game sufficiently so that everybody would learn. But this is how it happens. One person learns, and then people imitate the successful strategy later. So instead of doing only one transaction, we do all possible transactions where bid is greater than ask. So now what will happen? So now the real way to find out is to run the experiment, and actually we did that. But we can think about what would happen by using theories about how people behave. And so I'm going to put forth a very simple theory. I am going to say that successful people stick on their strategy, unsuccessful people change. This is a very simple theory. It may not be true actually, and that's something we could find. But with this basis, we can calculate what would happen in this game. So we start with suppose that we have run the previous experiment. So people are now, as we did in the class. So people are now stuck at this Nash equilibrium. Everybody is bidding 150. All of the buyers are bidding 150. All of the sellers are bidding 50, asking 50. So now we say, okay, now we change the game. We are going to complete all transactions, and we as I announced it. So what will happen? 2 transactions will now take place. Both the sellers get the ask, and 2 of the 4 bidders get their bid, and 2 of them are frustrated. So now two bidders will fail. These people have the incentive to change strategy, but there is no available bid that they have. That is, yani, if they bid lower, they will not succeed in the next round, and if they bid higher, they are forbidden by the rules. So all they can do is replicate. So there is no change that is coming from the buyers. The two, unlike the case I discussed earlier, where the unsuccessful buyers can bid high. So here then the conjecture is that if we remove the limit, I put the limit back on, then these buyers, the 2 frustrated buyers, will bid higher, and that will actually cause more speedy convergence to equilibrium. Now there is a very interesting literature which I haven't studied, but it was mentioned in the book, that if you put artificial bids, artificial limits, that slows down convergence. So here is an example. The bid ceiling at 150 is not binding. I mean, the equilibrium price Oh, sorry, it is binding because 150 is the equilibrium. So if we but it's not yani, you can still achieve it, but the buyers are not allowed to go above. So if you remove the ceiling, let's say okay, your ceiling is now 200, even though your valuation is, then I think convergence will happen faster in an experiment, because the frustrated buyers will bid 160, then 170, and they can go up to in fact 300, but let's say we put the bid at 200. Now, but then something else can happen. That is something very important that we need to consider. Now, both of the sellers are succeeding. They are making sales, they are making good profits, and as the buyers compete and they go up to 200, let's say, then they are happy. There is no incentive for them to change. So again, the equilibrium will emerge, and I think something like this was happening in the game that we played. That if the structure of the game is not known, the people don't know that there are 4 buyers and there are 2 sellers, which is what's happening. I mean, we only look at the matching bids, we don't reveal the excess demand. Then there could be convergence to this equilibrium where all the sellers are bidding 200 and all the buyers are bidding 50, or even all the sellers are bidding 300 and all the sellers are bidding 50. And the fact that the sellers can raise their price will not be known to them if they follow this learning rule that I'm successful in making a sale, and so I have no need to change the price. So now there are 2 variations which succeed in kicking us to the competitive equilibrium. One is a slightly more sophisticated learning mechanism. Suppose that both successful people and unsuccessful people experiment. The unsuccessful people experiment much more. They experiment with 90% probability. The successful people experiment with 10%. I'm doing well, but maybe I can do better. So the seller could try, and given zero information, both tries are possible. One seller could say, okay, I'll go for 40 and maybe I'll win. And that strategy actually works in the previous game, that he would get the only sale. The sellers doesn't know that there are 2 sales being made in the zero information. We just give them the sheet back, and one seller finds out that I have made the sale. He doesn't know. In the game that we actually played, the sellers were, I revealed all the information about the game. So that's why Asma was able to calculate that the seller can now make a high bid, a high ask. And so she asked 90 and she made a lot of profit. But in the zero information, everybody is isolated. You only find out whether you succeeded or not. The sellers do not have that information. And so the sellers can experiment. Their incentive to experiment is much reduced. So if the seller bids 40, he will also complete the sale, and the seller bids 60, he will also complete the sale. So now the seller who bids 60 will make more profit than the seller. So if they are experimenting, then the seller can experiment with both high and low bids occasionally. So 1 game in 10 they might experiment, and then they will find that the high bid also wins and the low bid also wins. Meanwhile, other changes are happening. The buyers are competing with each other. So it's very difficult learning situation. But in principle, the sellers could learn that a high bid succeeds also. And once they learn, then they might keep experimenting and going up slowly. And so, in principle, once if we allow, so the learning mechanism is crucial here. Suppose we say that the sellers experiment with 50% probability and they try both small increase and a small decrease. So then in about 10 trials they would learn that making a high bid gives them more benefit than making a low bid, assuming that the buyers have stabilized at the upper equilibrium. Otherwise, if the buyers are changing, they won't be able to easily calculate which one is better because the situation will keep changing. So, assuming that they are in the set, if the setup is correctly, again the experiment, you see, the experiment needs to think about the learning strategy and how we can get it to work more efficiently. So ultimately I expect that with normal human learning, in a long series of games like 100 games, the buyers would stick at the maximum 300 or 200. Then when the sellers start coming up, the buyers will start going back down because now they are making losses at 300, and ultimately the convergence would occur to the competitive equilibrium where the sellers are asking 150 and the buyers are bidding 150. So this would happen in this game if the learning mechanism is right and if the experiment is conducted sufficiently long period. But it could take a very long time if the learning mechanism is random trial and error and things keep changing, so the sellers don't learn very quickly what is happening. If we reveal to them the structure, then they can see that we should bet, we should make a high ask. So all of these things that I am telling you are just experiments which have not been done, and it can all be publishable research. So to summarize this lecture, what do we learn from all of this? Well, basically the question that we are trying to find the answer to is, why does convergence to equilibrium happen in oral double auctions? So the Gode-Sunder hypothesis was that it happens because of the structure of the oral double auction. So the answer is, it's not the structure of the oral double auction, it's not the market structure, which is what they thought, the procedure that. It is the Marshallian path which leads to convergence. Marshallian path plus market structure. I mean, you have bids in sequence. Suppose we ran the market in parallel, that all of the people bid, make only one bid, all of the people made only one ask, and we just trade all of them at once. Then again we will not get convergence, because in the second round again it would repeat. We could actually look at that structure and there would be no convergence. So it's only the sequential nature of ODA which is not actually matched to real markets, because in real markets you have parallel. So again it's the sequential bidding in ODA together with Marshallian path which leads to convergence. So this is a misleading insight, because in markets, if we have parallel trading, all bidders and all askers are simultaneously trading, then we will not get convergence because we will not have Marshallian path. Now the plot hypothesis is that if you change the structure of supply and demand so that there is no Marshallian path, then convergence does not happen. So we saw that, and actually, so we look at the box design where there is no Marshallian path. So the proposed solution to the mystery of why convergence happens is that people have a certain learning mechanism. People just make bids at random. Then those who are successful repeat their strategy, and those who are failures try to change their strategies. And under certain conditions, this would cause convergence, as we saw. Not under all conditions, in certain types of structures. So basically, the thing that we started out with, I am repeating that slide. We want to explain how this is happening. So the economist idea of an explanation is to construct a game with optimization behavior and equilibrium, which will create that behavior. As we have said, this is not the right way to think about it. What we want to do is to construct models of agent behavior and agent learning which will replicate this. So people start with random bids and asks, they are randomly matched, the price becomes known, and so we saw that in some situations this will lead to convergence. In other situations, it would not. We have some hypotheses about behavior. We also have some hypotheses about convergence in different situations which we don't know how it will work. I don't know at this moment whether we can replicate. Basically we're trying to find an experiment in which this thing that we have seen will happen, and I think that that is the first 5 rounds you will get convergence, and then the next 5 rounds you will get convergence to the other equilibrium. Can we make that happen? At the moment I don't know whether or not. We have studied different types of structures in which this will happen, but with great difficulty because the learning is difficult. I think you go back and look at the original papers and see how they constructed the experiment. I think that their experiment, if you go to the original oral double auction, then the bidders are bidding in continuous time. They are just shouting out their bids. So I think that that leads to more learning. You can get a sense of the market by seeing how enthusiastic the bidders are, and so you can learn much more quickly, and so you can get convergence much more quickly, because if the sellers realize that there are 2 of us and there are 4 of buyers, then they will be quickly able to understand that we should raise our prices. But in the situation where we had, where there were sealed bids, they will not learn whether we have. And actually the way I conducted the experiment, it was even more difficult to learn because the sellers were not fixed. We kept randomly rotating. So the seller who needs to learn, in 6 plays there were 2 sellers, so they would get a chance to be a seller once in every 3rd game. So then learning for sellers would occur very slowly. And then, as we said, sellers will always be successful, so their incentive to change the strategy is even less. So these are the parameters which we need to learn about to design from the experiments, which we don't know. And you can design experiments in a more efficient way to get better learning, to see if once you have a hypothesis. You see, this is another thing that is important to learn, that you don't go with a blank mind. This is very contrary to what you have been taught. You don't go with a blank mind, run an experiment to find out. No, you have a very strong and very clear idea of what will be happening. This is the true. All models that you make are not, model is, you have been taught that models are there to teach you things. No, actually model represents your theory. You have a very strong, clearly articulated theory. And then you test this model. Okay, this is my idea of how people behave. This is my idea of how people learn. Now let us see if what I am saying, what I am thinking is right. Then you you construct an experiment, and you find that your model fails to predict the results, just like my model failed to predict the results of the student. Then you think more about it, and then you change the model to create better conditions which will allow the convergence to take place. So given your model of learning and behavior, which you can acquire by running some experiments, you can actually run experiments which will teach you something. You start with the hypothesis. When the experiment violates your hypothesis, then you learn something, and then you modify the model. This is how scientific theories are built and modified. It doesn't, supply and demand convergence doesn't happen by magic, it happens by experience.